We would like to give a very warm welcome to all of our attendees today. We appreciate your support over the last several years. The Quantum Business Law Consortium is dedicated to ongoing education for lawyers and accountants and business owners. One of the challenges that have been brought to our attention is how to interpret fairly recent legislative changes and also case law that's had the effect of creating extra vulnerability to negative assessments by taxpayers across Canada. There's various different issues that we've been running into recently. We've been seeing situations where business owners have been advised by both lawyers and accountants at times to do things such as transfer clients from one company to another without necessarily taking into account that they're triggering a taxable event. That and many other issues that we see with some regularity creates concern. We've also seen situations where shares have been issued to family members out of Treasury without taking into account the tax effect that it would have both as a shareholder benefit and through the dilution of shares of individuals triggering a disposition of the shares. Other issues we've been running into is lack of regard for small business deduction planning. Some of the opportunities that we've been using for decades have disappeared after 2016 when the new small business deduction rules came into play that prevented many of the traditional type of small business deduction planning methods that have been utilized without incidents for a number of years. Well, no longer are those things available. And CRA is obviously watching closely at companies that are making an attempt to create multiple small business deductions, having the effect of a lower rate of tax on the first $500,000, but multiplying that for opportunities with various different companies that are not operating at arm's length. In other words, are involved with family members within corporations. These rules are highly complex and require more than the usual attention in order to ensure that you're not going to be caught in a trap. Other situations we've seen are situations where there's synthetically created losses, artificial losses that have been created and have been claimed, and we're going to be talking about that too. We've seen situations where the PUC or paid up capital, the tax cost of shares have been increased in order to create tax benefits. We've seen situations where there's been very aggressive planning that's been done with what's known as surplus stripping, which essentially means that you're taking what would have been a dividend, a taxable dividend, converting it into a capital gain. In particular, the types of structures that are disconcerting are some of the ones that trigger the capital gains exemption and more or less involve non-arm's length parties in a way that one is putting himself at risk. We're seeing issues with spousal attribution rules where income and capital gains are attributed back to a spouse without understanding, in situations with estate freezing, where estate freezes have been done, where beneficiaries are added, where there's a tremendous disparity in income between, say, a husband and wife, without consideration for what kinds of tax consequences might come about. Other situations we've seen involve the use of debt forgiveness strategies that can have a result of income inclusions that are rather unfavorable. There's tax treaty issues that we've seen where companies have attempted to move exempt surplus into Canada tax-free from other countries that have tax treaties with Canada. We've seen situations with non-resident trust rules under Section 94 of the Income Tax Act, where individuals have attempted to take advantage of foreign jurisdictions in order to create tax benefits. We've seen situations under the TOSI rules. A lot of the things we're talking about today are post-2016, including 2017 with the amendment to legislation that created prohibitions on certain kinds of planning. That's called straddling. Donations to charities. We've seen lots of situations over the past years where individuals have undertaken to make donations that didn't quite match the tax benefit. Now, I'm sure none of these things are a surprise. Everyone who is in business and who's a taxpayer has undoubtedly heard of some of these schemes. And we're here to help you. We're here to assist so that we can begin to help you to be preemptive so that you can have a more fireproof situation before CRA comes knocking. So maybe, Jeremy, we could put the slides on the screen for the benefit of the audience. And as he's doing that, I'd like to introduce our expert panel. I'd like to introduce Michael Miller. Maybe Michael, just give us a brief explanation about your background and your role with Quantum, please.
Thanks, Todd. I'm a litigator, have been for over 40 years. The tax world is very interesting and very complicated, and the tax courts follow the lead of CRA sometimes, not always, and so it's an interesting thing to observe. And I'm going to be talking about a recent interesting case today.
Oh, thank you, Michael. Mayor, maybe give us a quick overview of yourself and your role at Quantum as well, please.
Hi, everyone. I'm a partner in Quantum, and I'm a litigator also. I'm also involved in tax planning and utilization of trust within that tax planning.
Very good, very good. Anyway, so this is our expert panel, and we're here to try to shed some light and adjust that proverbial lens to refocus, to help people to understand things with clarity. The first issue we're talking about is whether or not contractors are really contractors. Are they employees? And of course, we're aware of the situation. Any of you who are in business are abundantly aware of the fact that, you know, when you hire someone, if you make them a contractor, well, there's certain types of deductions that you don't have to make, certain types of remittances that need to be made. And also we have this issue of Canada Pension Plan and EI insurability, where there's a requirement for deductions at source and remittance to the CRA. And we have been seeing a rising number of companies who have fallen into a trap of treating individuals like contractors, only to have CRA come in later and say, these are not contractors, these are employees, having the effect of very large assessments against companies. And through COVID-19, I think a lot of us have possibly fallen into a false sense of security, but if we think that CRA isn't looking, they certainly are. And there's an inordinate number of these cases. So we'd like to talk to you about how you can be better prepared if you have contractors who might be, in the eyes of CRA employees. Maybe, Mayor, I just ask for you to tell the audience about a case that you've been working on and maybe give them an understanding of how this might apply, please.
Sure. Thank you, Todd. We've had several cases that deal with these issues. One recent case, over 200 employees were assessed to be employees and not contractors, and the client has significant tax bill owing. What we're also seeing is, I'd like to point out, because it's an informal procedure, the trial level, we're seeing a lot of self-litigants, and we're seeing a lot of agents representing litigants who are not lawyers. As such, a lot of these cases are losing, but they're getting resolved at the Court of Appeals levels. So it's important to get someone that knows these issues involved early on in these cases. And there's criteria that deal with this under CRA: level of control, whether you provided tools, whether the contractor can hire assistance, financial risk, and other relevant factors. But there's a deeper dive that you need to take. One is look at, for instance, the leading case, Supreme Court of Canada case in CEWS. It was a determination status of whether a person was an employer or independent contractor. Although that was in a tax court case, it did adopt the weave door principles, and the test, which is a major test you have to overcome, is not just these factors, but the major test in weave door was actually a synthesis of U.S. Supreme Court case and British case. So the test is the person who has engaged himself to perform these services, performing them as a person in business on his own account? If the answer to that question is yes, then the contract is contract for services. If the answer is no, then the contract is of services. Now, another thing to look at is not just the criteria, but you have to look at the facts. recent case, Royal Winnipeg Ballet, was a Court of Appeal case which overturned the Tax Court of Canada. One of the reasons was because the Justice and Tax Court failed to look at the intent of the parties. Now, this is sort of a subjective objective test. For instance, if I'm the employer with the contractor or employee, we both believe that this is a contractor relationship, which is subjective, but objectively, our actions also have to lead to that conclusions. And that's what the Court of Appeal said in Winnipeg, Royal Winnipeg Ballet. Intent is very important also.
Yeah, the intent as to, if you're hiring someone, in their mind was the intention to be an employee or a contractor. That's one question. And the second part of the question is, what is the employer's intent? But sometimes the facts don't match the expressed intent. Is that not true, gentlemen?
That's true. And that's part of the objective part of the test, is the facts have to match both your subjective intent.
Traditionally, a lot of companies, and we're hearing it today from a lot of accountants and lawyers as well, that have been giving advice, as to whether or not they should be treating people rightfully as a contractor or an employee. And oftentimes we hear that the criteria that's being used might not be 100% up to date. Sometimes it is based on things like, if the other person has other employees, well, they may have other employees, but they may still be employee versus a contractor. I should have said other customers. So if you have a contractor that has other customers, it isn't enough. Or if you have contractors who use their own tools, it isn't enough. And there are situations where CRE is taking a very, very hard-lined approach for situations where individuals arguably have other clients other than the company who's purported to be a contractor, situations where their equipment and resources are all held by them. So there's a few other issues that might be worthwhile talking about. And if you think about it on a very, very logical term, if an individual in fact is a contractor, they're presumed to be in business for profit, aren't they? And as a consequence, one would think that there should be some risk of loss as well as an opportunity to earn additional profit. Mayor, how does that factor in?
I think all the points you made are valid. It's important with these types of CPP EI cases, we're finding that it's important to get engaged with the clients early on at the audit level when they're speaking to the auditor. What they're saying is important. In litigation, facts are what drives the case, but especially with these cases. For instance, I'll give you an example. Let's say we have contractors. I have a company that I have sales team that goes out to sell, let's say, bread. This is a horrible case example, but follow me. If we have contractors that are selling bread to stores, the contractor is liable for the risk of loss. Let's say they damage something in the store and they're liable to pay the damage. Well, this is good because it shows the pendulum swings in the favor of contractor because they're liable for the risk of loss or any damage. But then the auditor subsequently asks, well, how do they pay for this? And as an employer, I tell the auditor, you know what, I deduct it from their pay. Well, that, just saying that in itself, the pendulum swings towards control and you have control over that person, right? So it's very important to get directly involved with these cases at a very early stage when they're making statements to the auditor.
Perfect.
Todd, because we're in COVID and people are not coming into the home office of the employer, it gets a little more difficult. One of the key tests is, did you have an office in the employment of the contractor, and did you come in and did you use all the equipment of the employer? And if so, you were deemed to be an employee. But now people aren't coming into the offices, so it gets a little more blurry. You're working from home. Does that mean you're not an employee?
Yeah. So to all of you in attendance, our advice is don't wait until you have an audit. There are things that you can do today, such as ensuring that you have proper agreements and that both sides have common intent. And if you don't have common intent, then that discussion can be had. And this is a question of balance and judgment. So we're not here to tell you that you have a problem, but it would be best to find out. And this is something that you need to look into, and you need to get professional advice as to whether or not your contractors are going to be considered employees according to CRA, which could result in a massive tax assessment if you're not taking proper care. So this is something we'd like to suggest to all in attendance, lawyers and accountants, as well as business owners. Please be mindful of that. Let's move on to the next section. In light of COVID-19, there's certain relief efforts that the government of Canada has extended, which is putting the government of Canada in a tremendous deficit. In order to balance the books, as it were, we can count on the fact that the CRA will be looking to implement enforcement. And since we're in a self-assessment tax system, many companies across Canada, and we've been working with some of them, have run into problems where they've received this emergency wage subsidy funds, CEWS, resulting in CRA coming back and saying, we don't believe you're qualified, or we have questions, leading to them not believing they're qualified, necessitating companies who have received wage subsidy to repay the funds. And again, there's things that you can do to understand best how it works. So maybe I turn it back to the panel again, and maybe, Mary, you've had a case, I believe, in wage subsidy where CRA has actually come back and asked for amounts in over $1 million of repayment of wage subsidy. Maybe just share some high-level details, and hopefully some in attendance can relate to what you've said.
Sure. Some of the recent cases we have, let's talk about the interesting fun stuff with wage subsidy. One is, I'll give you a quick example, extraordinary items. Let's say I'm a manufacturer. Again, I apologize in advance, my examples are horrible, but let's say I'm a manufacturer that makes dolls. And during the period, relevant periods, COVID periods, I turned my manufacturing to make water, right? Those qualifying revenues under 125.71 will be excluded from calculation of qualifying revenue if you meet certain tests. If for instance, the water is not to be expected to occur regularly or frequently within several years, not typical of the normal activities or risks inherent in the normal operation of the entity, and primarily out of control of the owners or management. Well, our firm, we've taken issue with the last requirement, and that's what we're hoping to fight, bring in dispute with the CRA as the last issue. Also, if just quickly, there's a couple of elections we're finding people are not electing or utilizing that could be beneficial for them. Under 125.74E, you can choose, there's qualifying periods. Everyone knows, might know the qualifying periods, March 15th to April 11th, April 12th to May 9th, May 10th to June 6th. Now, how you calculate your qualifying revenue, you can make an election. For instance, I can elect to use the cash method or the accrual method. This may be beneficial because the cash method is utilizing when we receive the funds or cash, and the accrual method is obviously when we deliver goods or services. These two events could be times apart, and you could choose to choose one time or another time. And when you choose these certain events, it may benefit your qualifying revenue.
So let's think about how this might exist in COVID-19 environment, and say, as an example, that a company deviates from its regular production of product, and they decide to, say, manufacture PPE devices of some kind, whether it be gowns, face masks, whatever it might be, or hand sanitizer, who knows, anything at all that could be unique and common to the time that we're living in. And of course, is this really an extraordinary item? Well, there's a very interesting argument to be made as to what constitutes an extraordinary item. Generally speaking, the term extraordinary item is not defined in the Income Tax Act. It was defined under previously under CPA guidelines that were a definition of terms and have been adopted, and trying to determine really what this extraordinary item is. Well, generally speaking, it's something that you haven't done before, and it's something that you're not likely to do again, or not with any frequency. And it also should be something that you have no control over. And why are we talking about extraordinary items? Because in reality, the test for determining whether or not you're eligible for this wage subsidy benefit will depend upon the revenues that you receive. Now, you may have received significant revenues that would render you ineligible, notwithstanding the extraordinary items that you're manufacturing or you're producing or that you're involved with, that could possibly provide an opportunity for eligibility where otherwise you're not. One of the issues there is whether or not you had a choice in the matter, which is a pretty interesting question and an interesting legal argument as well. One could argue, well, any business, any taxpayer in Canada has a choice whether we go to work today or not, right? Or whether you do anything, you always have a choice. But is it sufficient to say that a corporation had pressure because of the being called upon and being a good corporate citizen, fulfilling civic duty by manufacturing things that save people's lives during shortages of PPE devices? Who knows? We're going to find out. But what we're saying is that, again, we've got to be very careful. So if you've received emergency wage subsidy benefits or intend to, it's pretty important to get expert advice on that too. Okay, let's go on to the next slide, please, Jeremy. So here we have a few different issues. And at the very beginning of the presentation, I was talking about some of the problematic issues. And certainly there's issues that we hear about that are being promoted. Well, I'm calling them promoter strategies. Well, we see situations where there's future currency exposures that ratios that can be in effect invested in simultaneously, giving rise to an inevitable loss. In some instances, it may be that companies are well within their rights to invest in certain kind of strategies. Each situation needs to be looked at carefully. If there's artificiality, it's always in any type of tax planning very smart for a business owner to stop and take note and say, is it synthetic or artificial? Is it a real loss? Well, if the loss was inevitable, can it be argued? Well, there happens to be a change in legislation that was enacted in 2017 that dealt with this very issue that we call straddling. Michael, maybe I could have you talk to the audience about a recent case heard by the Tax Court, the Tax Court of Canada. Michael, please.
Thanks, Todd. Well, the case is the estate of Paletta versus the Queen. And in fact, the decision came out February 23rd of this year. So it's just 7 weeks ago that it was decided upon finally by the Supreme Court of Canada. What Mr. Paletta did, he wanted to defer the taxes that he would be payable in any given tax year. So he came up with a plan, and it was designed to generate non-capital losses through forward foreign exchange trading. So it was a very simple plan. Buy one long contract and also buy a second short contract. And that's called the straddle. And the contracts would almost completely offset each other. So at the end of each year, Mr. Paletta would meet with his accountants and decide how big a loss that he wanted, if you can believe how that works. And they came upon a figure, and he would sell. Then by December 31st, Mr. Paletta would sell his contracts and take that loss into effect. And he would do that at the end of each year. And then shortly after December 31st, he would then defer, he would then take the gain and put it into his income for the following year. And he kept this going year after year, specifically year 2000 to 2007. And just as a side note, this case has been argued for 14 years. You can imagine the costs that have been incurred at all different levels of the court system. And he did this for 7 years specifically. The minister decided and made some assumptions. And the assumptions were that Mr. Paletta was misrepresenting what he was doing to the minister, to CRA every year. And he put that, the minister put that into the area of neglect, carelessness, or willful default. But the court found at the lower end that the foreign exchange trading was not a sham and followed the Friedberg and Stewart cases in doing that. So as an example, I'll give you a couple of examples. In one of the years, Mr. Paletta claimed a trading loss of $3 million for tax purposes, but all he actually lost was $18,000. Another example, in another year, he reported taxable income of $450,000, but he had a trading gain of over $6 million. And the minister thought, was not very happy about this. So they brought the case, and the Crown argued at the trial that the trading was not a source of income. It also was a tax loss scheme and not a business. It was a sham for foreign exchange contracts, and it was window dressing. That argument was failed for the Crown, who then appealed and went to the Federal Court of Appeal and then lost that. And then the Crown kept going to the Supreme Court of Canada, and Justice Iacobucci held that, I'll quote, "We are all of the view that the appeal should be dismissed with cause." That's the Supreme Court together was unanimous. And in their findings, the Supreme Court said that the closing out of the loss legs of the straddle, the trader will thereby realize a loss for that year. But such loss is not diminished by the value of any related gains in the following year. And that was the decision. Now in March, I think as you mentioned, I know you mentioned, Todd, in March of 2017, the government introduced specific anti-avoidance rules regarding straddles. But the Supreme Court said, notwithstanding that it was in 2020 and 2021, that the straddle legislation was on a prospective basis and it wasn't to be retroactive, so they lost. And they lost with costs. The interesting part of this, well, it's all very interesting, but it's what the definition of a sham is. And the court in Ansell and the Queen held, it suffices that parties to a transaction presented as being different from what they know it to be. So that's basically what a sham is. In this case, Mr. Paletta reported it every year, took it into account in his tax payments, and it was accepted by CRA. So what's going to happen now is we have to decide, the courts will ultimately decide whether the Supreme Court of Canada decision in Paletta can be overturned by changing legislation in 2017. And it is available to the government to have change the legislation to close loopholes. But this is a Supreme Court of Canada decision, pretty important, Todd, and it remains to be seen what's going to happen.
Yeah, thank you, Michael. So just by way of summary here, I think it's really important to understand that a few things that I think are good takeaways from Paletta. And one of that is that the amendment to the legislation in 2017 was not retroactively applied. In Paletta, the statement from the justice was that those amendments changed the law on a prospective basis. They did not change the law retrospectively. So it's very important to understand that. So in other words, for taxation years, say 2002 to 2008, well, the legislation hadn't changed for several years. So I think that it's a very good and comforting issue because often we see situations where current guidelines, current law is applied in some cases previously, and it really shouldn't be. And I think this was one of the things that makes this a spectacular decision. Other things that I found kind of interesting about it was that the Crown's position, or the minister's position here, is that there was no business purpose for this. This was a sham. Well, the fact is that there is a business purpose. The CRA may not agree with the business purpose, but it wasn't a hobby. It was done to create profit. In this case, it's to create losses. So the argument itself could have been better in this particular case. The fact that a sham may have existed in the mind of the Crown, insofar as there was an inevitable loss that just resulted from the series of transactions, which effectively straddling a high and low position, that had the effect of creating a predetermined loss based on what the accountant said this year. Oh, what would you like your losses to be this year? How much tax do we want to pay? Well, that's not what a sham means. In fact, the documents that were submitted, the documents that were signed, the tax returns, the claims, all of the background documents none of them were misleading. In order for a sham to be so, it has to be misleading. And even if it was a sham, didn't have an issue with respect to an actual lack of business purpose, resulting in denial of that loss. I
Right,
think.
and- Sorry, Tom. In fact, the Supreme Court dealt with that. They said that there's no business purpose test in Canadian tax law. There's no test for it. And a lack of a business purpose is not a sham. So they were very specific. They agreed with you, Todd.
Yeah, so well, that's comforting. At least someone did. So what we're really getting at here is that GAR, general anti-avoidance rules that we'll be dealing with shortly. Yeah. Was there any purpose? Well, and Paletta, it was noted in the reasons for his decision that there was no purpose other than saving tax. So does it give us comfort to say that we can just do these artificial transactions? When I'm saying artificial, creating a loss based upon transactions that are sure to have that outcome. And the only purpose for doing it is tax avoidance. We're suggesting caution. If you're already involved in these situations, we suggest that you have someone look at it closely. And if you're contemplating getting involved, again, same thing, right? Chairman, let's move on. Oh, hold on a second here. We have a couple of other issues, but we'll move forward in the interest of time. So we want to start off by saying that our tax system is based upon an old case heard in Britain. And we like to talk about this because the fabric on which GAR exists, GAR being the general anti-avoidance rules, is based with the backdrop of this particular case. And perhaps you've heard us talk about the Duke of Westminster, the second Duke. You've probably heard us talk about the seventh Duke. So in other words, maybe the fact that there's a heritage and within this the Dukehood, as it were, that did allow for significant tax benefits, most recently with the seventh Duke, probably existed because of this particular fellow here. And of course, we know that he had a gardener, and the payments to the gardener were not deductible for tax purposes. And through some very clever thinking on behalf of his lawyers and accountants and so on, they came up with a scheme that they would, rather than pay a regular method, they'd make an annual payment and divide that by weekly installments, creating tax deductibility. Well, long live the Duke. And I believe it still exists. And it's part of our tax law in common law that we would subscribe to. And I find these words to be a breath of fresh air, but please take it with a grain of salt because everything has its limits. So just to paraphrase, and you can see the words there, but every man has the right to order his affairs so that the tax consequence can be lesser. And even if his fellow man and the tax authorities don't like it, well, he shouldn't be forced to pay the higher rate of tax. So that's kind of the issue that surrounds GAR. And when you're looking at doing planning, it's very important to really understand what GAR was all about. And that was established through Canada Trust Co. We'll talk about that in a minute, but Jeremy, can you go on to the next slide, please? Chief Justice Donald Bowman, the Chief Justice of the Tax Court of Canada, has been an incredible proponent of fairness. He has, through various decisions, but through the Tax Court of Canada that he presided over, he always tried to preserve the rights of taxpayers in a fair and equitable way. I don't think any of you lawyers or accountants and anyone else in attendance who's familiar with the decisions by Chief Justice Bowman would actually argue about that. But in reality, there's various different arguments that have existed dealing with issues such as form over substance. And one of the ways that I quite liked, I interviewed Chief Justice Bowman the last several years. And one of the things that he said to me one time, he said, Todd, you can put lipstick on a pig. He says, you can dress up a cow to look like a horse, but it's still just a cow. So I always liked the clear and very equitable way that Chief Justice Bowman managed to carry out the issue of GAR and to preserve the integrity of the Duke of the second Duke that we've been talking about. Let's move on a little bit further. We're going to get into a discussion on this whole GAR issue. So in Canada Trust Co., there was really a three-part test. And if you think about straddling and you think about non-Canadian controlled private corporations, and we're going to be dealing with that shortly, and I'm guessing that many in attendance have either, if you're a lawyer or accountant, you might have recommended that the past years. And secondly, you may have taken another position as a business owner and said, well, I want my company to pay a lower rate of tax. I don't want to pay tax at 50.13% in most provinces. I'd rather pay the general rate tax. Well, one can argue it 100 ways. One of the issues could be, well, there's two boxes in the front of a T2 tax return. One is a CCPC, Canadian Controlled Private Corporation. The other one's a non-CCPC. And if I have a company that's controlled by, say, a holding company in Delaware or British Virgin Islands or somewhere like that, well, have I legitimately succeeded in lowering my rate of tax? Because if you have a non-CCPC, you don't have to pay federal refundable tax or surtax. And the tax rate goes from 50.13 down to 26.5% on regular general rate income, and then from 25% to 13.25% on capital gains. So what we're seeing is a lot of structures. In the anti-avoidance section in CRA, it's well known they're targeting these kinds of structures, mostly for artificiality, mostly because there's no bona fide purpose other than one, they're trying to save tax, which flies in the face of Canada Trust Co. Was there a tax advantage is the first criteria. Well, certainly there is. By reducing your taxes by 50%, how can one ever say that there's no tax benefit? The other thing is there a bona fide purpose besides obtaining a tax advantage? Well, there's no clients in British Virgin Islands or no offices in Delaware. There's no employees there. The reality of this situation is that in many of these structures, and we've been warning people about them for years, and recently at the Canadian Tax Foundation, those of you who have attended last fall would have heard that CRA made the announcement that they're going to be auditing these companies, and it's happening across Canada. So if you're in this kind of situation, it would be wise very wise, to have an expert look at it with a view to determining what are your risks, and more importantly, what is the remedy. You don't want to wait for CRA to come knocking on this issue, because the result could be quite serious. Maybe what we'll do is we'll go on to the next slide and develop this conversation a little more. One of the ways that this can be done is through what's called a continuance. In effect, you have an investment company in Canada, and you decide to continue that company into another country, giving rise to that company becoming a non-Canadian controlled company. Therefore, the result could be quite severe. Oftentimes we hear of people, well, I'm the director of the company and I'm running the company from here. Well, that's fine. But what is your reason for doing it? Is it for anything other than reducing tax. And I've been waiting for many years to hear a good explanation on this one. And I don't really believe that it's the best kind of planning. I believe there's better kinds of planning that can constitute numerous bona fide purposes, such as intergenerational transfer of wealth, such as asset protection. Canada has become a country that in many ways favors creditors and oftentimes looking outside of Canada to establish trusts and other vehicles, not with a view to taking advantage of the lower rate of tax in those countries, because we've been known for setting up trusts in New Zealand, for Barbados, and private trust corporations in the state of Wyoming, Nebraska, Alaska are also very interesting places if there's a US connection. But we're looking for destinations that have asset protection legislation, or that doesn't have onerous legislation, such as we have in Canada. As an example, in Canada, we have the Fraudulent Conveyances Act. The wording in this act is derived from the 1600s, the Statute of Elizabeth, that has the effect that a court can make it a special award under the Fraudulent Conveyances Act, having the effect of piercing a corporate veil or breaking a trust. Anyways, let's move on from there, please. Before we get to that, maybe Michael, I'm just calling you to comment about jurisdictions outside of Canada and reciprocal enforcement. So we're talking about creating asset protection as a bona fide purpose for doing certain kinds of planning. Michael, if you established, say, a trust in a foreign jurisdiction that held shares in a company back here in Canada, and we had operational control in Canada, but we had common control, common mind and management control out of Barbados, as an example, or New Zealand, or one of numerous various different jurisdictions that we would oftentimes consider. What are the chances that if there's no assets there other than shares of companies back here in Ontario, as an example, or British Columbia, for those of you from BC, don't leave you out, how would you describe that issue with reciprocal enforcement? And what would be the risks to an investment company that didn't have any assets there, but merely had shares there, which controlled the companies back here in Ontario or in Canada?
Yeah, well, if it's Commonwealth country, we're all equal and can honor each other's judgments or findings with no issues. In the United States, there's a group of companies, of states that have come together to form their own sort of legislative reciprocity. So in countries that have similar, not the same, but similar laws as we do in Canada, and it's a well-organized system, we can accept their judgments as well. It takes, it has to pass in Ontario, it has to pass a court approval for that to take place, but a court approval, as long as it's not fraud, or as long as the parties that are together are aware of the court action, then they will be accepted here in Ontario.
Michael, let's move into funding. We're talking about this famous Guerin case, right? Where did they go wrong? Obviously, just to set the stage for what happened, there have been numerous attempts by individuals to take advantage of lower tax jurisdictions. And under the NERT rules, under Section 94, trusts are often considered non-resident trusts and therefore become, in effect, Canadian taxpayers. Well, in this case, that's not what they did they? What happened in this Guerin case or funding?
The Guerin family had the actual and physical and any other type of control of the company here in Ontario. It was not being run. They were in a Caribbean country, not Barbados, but another one, and that was under the guise that the business was running in the Caribbean. But in fact, anything that had to do with the business, any decision, any thinking, any strategy was all done here in Ontario. And the court said that that trust was set up for no good reason because it's being controlled from here, and overturned the trust. And
looks like we've lost Michael.
Picture. Yeah, I'm back.
Okay.
Am I back?
Yeah, go
So,
ahead.
yes. Anyway, they reversed, they canceled the exemptions because of the trust and tax the taxpayers. No
Mayor,
exit.
oh, thank you, Michael. Mayor, just call on you for a moment, just to maybe comment on instances where the courts may be inclined to break a trust.
Thanks, Todd. You have sometimes trust, let's just 2-minute synopsis on trust. Trust go back to the medieval times. They're very sacred. There's a lot of case law surrounding trust. Trust is not an entity like a corporation. It's just a relationship between parties. And I think you always give a good example of a trust. Think of it like a mailbox. When you're putting a letter in the mail is going to someone else. That's what it is. And the deed of the trust is really important and gives the rights of the parties within the deed. Having said that, trust courts are reluctant to break trust. The only times you sometimes see it in the OBCA under oppression remedy, very rarely, but a lot of times you see it. If you do see it, I would think it's more, you see some Court of Appeal cases like Spencer versus Spencer and family law settings where there's a divorce or a separation and there's a dispute over the amounts at issue for net family equalizations. And that's when the court will go through an analysis and see if, for instance, the principal trustee, I think it was in Spencer versus Spencer, was the husband. The court looked at several factors and looked at the facts of the case and saw that the husband in that case had de facto control over taking money out whenever he wanted, just dealing with the trust in a manner where he exerted control. Therefore, the court ruled that this was part of family net calculations and did, in effect, break the trust. Having said that, that's why when you set up a trust, it's important, as we do, we have a friendly stranger involved. It's not a self-dealing trust. How you set up the trust, the players in setting up the trust is very important. And I think one last note when we're talking about the Garang case, a lot of people misinterpret the Garang case thinking that you can never set up a Barbados trust. We set up international trusts all the time, and we do that through Section 94. Garang case, when we set up our trust, it's just for asset protection mainly, but through Section 94, our trusts are deemed Ontario. So Garang case doesn't necessarily apply to all Barbados trusts or international trusts if you use Section 94. For instance, trusts we set up, they do file T3 tax returns like an Ontario trust. So Garang wouldn't be applicable to that.
Yeah, so I guess what we're saying here, folks, is if you have a foreign trust, if you have a corporation, an investment company, and you've decided to continue into another jurisdiction, perhaps the state of Delaware or British Virgin Islands or somewhere else, it's important that you are analyzing this and have it reviewed through the eyes of the CRA and also from a risk point of view of what can be done, because there are remedies. We know that companies across Canada are now being assessed for this. And one of the comment that came to me fairly recently was, well, we didn't have any knowledge of these things. We left it up to our account. We've heard this before, but as business owners, you're responsible. I mean, the fact is that willful blindness is not an excuse. And that is something that the Supreme Court of Canada, in the case of Briscoe, had ruled on, where it stated that in circumstances where a taxpayer becomes aware of the need for inquiry, but he declines because the taxpayer doesn't want to know, or he's not studious in finding out the truth. Well, this is certainly a risk that we'd like to make everyone aware of. As far as being aware of a problem isn't in itself that necessary for CRA to take this very heavy-handed approach. And there's certain guidelines that we'd like to make sure that you're following, lawyers and accountants. So we provide this ongoing educational program across Canada prior to COVID-19. And we see a lot of situations where some of these nuances may be well served to incorporate into your practices, and we're here to help with that. Let's move on to the next slide, please. So here we're talking about a few other areas that we'd like you to be aware of. And one of the important issues that I believe is critical that I haven't mentioned yet, and some of these things we have, and we're going to be wrapping up in just 10 minutes, so we don't want to take much time. So we're seeing situations where companies have lost the eligibility for the capital gains exemption, and nobody's told them. So you accountants and lawyers in attendance, please be abundantly aware of two court cases. One is the Tax Court of Canada decision on Edward Riley versus Her Majesty the Queen, and the second is Insight. So if you're looking at assets that are building up inside of a company, and the assets are not actively used here in Canada, such as cash, mutual funds, marketable securities, real estate that's not occupied, and we see it all the time. Well, you have to be very, very careful, because it can constitute the loss of capital gains exemptions. And of course, these two court cases, Insight and Edward Riley, the Tax Court of Canada decision, stated that if the withdrawal of the cash or assets, I'm paraphrasing to apply to this scenario, although that scenario was different, if the assets that are held by the company are, if the withdrawal of those assets would have had a decidedly destabilizing effect on the company, then it would be considered active. Otherwise, it's not. And in the case of Insight, the Supreme Court of Canada rendered the decision that assets, and I'm including cash here, a lot of people don't think of that. You have millions of dollars or hundreds of thousands of dollars of cash that could throw you offside and could cause a contentious situation. We run into all sorts of situations where there's assets that are not necessary. They're not a mandatory precedent to trade. In other words, your company can still run without it. We're encouraging all of you to be proactive on potentially litigious situations where you may find yourself being denied benefits or denied deductions or having other problems with the CRA because ample consideration wasn't given. So look at your balance sheet, look at your accounts, the balance in your bank accounts, and ask yourself, is all that money really needed in my company? And if not, then be very careful. If you have life insurance policies with cash surrender value sitting inside of a holding company, please don't assume that it's not a problem. That life insurance policy is not a mandatory precedent to trade, nor would the withdrawal of the policy constitute a decidedly destabilizing effect on your company. So therefore, we're encouraging you to pay more than the usual attention to the kinds of assets you have, so that we prefer to not be helping a client later, but helping now. I'm going to talk a little bit about Section 160 of the Income Tax Act. And of course, we see all sorts of issues going on from a standpoint of general civil litigation. Well, if you're loaning money from an operating company to a corporation that holds a building, as an example, and you've got these related party loans that are not interest bearing, that have no repayment terms, it's not a problem from a tax point of view for Canadian companies to be in that situation. But what is a problem is to believe that you're not creating any exposure. In the event of a claim against the operating company, say the operating company has insufficient assets and insufficient liquidity in order to take care of a claim, to honor a claim in the event of being in a litigious situation with anyone. Well, one of the things that a litigator, an individual, a plaintiff is not going to ignore, he's not going to ignore the loan on the balance sheet. If there's a loan for millions of dollars or even hundreds of thousands of dollars, it would be very easy to call that loan, forcing the real estate company to repay it. The very reason that you're advising, if you're accountants and lawyers, to set up a separate corporation to hold the real estate is because you want limited liability protection. Well, you're losing it because you're creating a target, right? So we see this a lot. So we're encouraging you to think about it. The other thing I encourage you to think about is Section 160 of the Income Tax Act. When you're paying dividends from the operating company up to the holding company, well, CRA can apply Section 160. And if a company is assessed by the CRA and dividends were paid up, be very careful. That money is not safe. So we're encouraging you to take steps to ensure some fireproofness, if you will. there's ways that you can do this. Then we see other people doing butterfly strategies. And of course, we do a lot of butterfly structures and strategies. We employ them here. And essentially what it really means is you're purifying a company most often, in this particular context at least, meaning that we've got all this cash and insurance policies, other things sitting inside of a holding company, investments of all different sorts, real estate, whatever else. We're moving it sideways without a need to pay tax on that. I would also encourage you to be aware of the purpose test in section 55(2) of the Income Tax Act that has the effect of dividends being paid from one company to another company being recharacterized as a capital gain. So we're not trying to overload you. What we're trying to do is to express concern about some of the things that cause us to be alarmed. That if you see yourself in that situation, let's be careful. Jeremy, if we can have the next slide back on, please. We're going to talk a little bit. We're just going to close this subject off today with a conversation on scientific research and experimental development. It's been said that there's probably no more subject in tax that's caused more controversy than the issue of eligibility. What we'd like to do is talk to you about the legislation that exists. Section 248(1)(c) of the Income Tax Act defines a certain category of work that's known as experimental development. And typically this kind of work that's undertaken by companies involves an advancement. It says here work that's undertaken for the purpose of achieving a technological advancement. Okay, so let's talk about it for a moment. If you've been denied for scientific research, or if you're considering making a claim for scientific research, it would be very, very useful to be aware of really what this legislation means. So the word seems simple, but if we're talking about experimental development involving achieving a technological advancement, it would be pretty good to know what a technological advancement it means. Typically, there's no time to cover it today, but in Northwest Hydraulics, Chief Justice Bowman, who we've talked about before, as he was then called, defined an advancement to mean an advancement in one's general understanding, in this case, about technology, for purposes of creating new or improving existing materials, devices, products, and processes, including incremental advancements there too. So when you're considering whether scientific research has occurred within your company, whether you're a manufacturer, you've perhaps developed some software, perhaps you're a bakery, perhaps you're involved in practically any area of technology, one of the things that we encourage you to consider, because keep in mind that the CRA doesn't make the law, and they're not always right either. They do a very good job of administering the program, but in general, we're seeing situations that we've argued ourselves in court, and we have assisted many companies to achieve this kind of tax benefit, because every year the federal government's paying over $3 billion to 20,000 companies, and this is something that your company might qualify for. So the important thing to understand is that you have to advance your company's general understanding, not about knowledge that's known already, not about knowledge you can read in a book or learn online or take a course and get the information for, but learning through experimentation, through research, through analysis. It's often that companies perform this kind of work without even knowing about it. So we consider it to be very important to be able to take a position that demonstrates specifically what your company learned. And if CRA has denied your claim on account of no advancement, perhaps a lack of contemporaneous documentation or some other reason, then that would be it. We'll just wrap this up for now by maybe asking.
If I just could interrupt for 1 second.
Sure.
If your experimental work fails, does not come to an advancement that in a positive way, you still can get a shred claim.
That's right. It can be a failure. I think one of the important things that a lot of people don't realize, the advancement is not your product. The advancement is up here. Also, again, this will be a topic for a future day, but we'd like to be able to assist companies who are needing more understanding on this, and because we really feel as though this is a right in law that companies have, And I think it's essential that as far as being able to take a position, it's important to understand the meaning of various different terms. We've given you one term today, and that is an advancement, but there's much more to scientific research than just advancements in technology. At this point, we've come to a close of our program. Time flies when you're having fun, and I bet most of you in attendance didn't know the tax was so much fun, did you? Having said that, I believe, Jeremy, we've opened up an opportunity for questions. Do we have questions that have not yet been answered? I've been watching emails going back and forth or chatting going back and forth, and I'm just wanting to see if there's any additional questions that we need to answer before we conclude.
No, Todd, just one. We've answered a lot of questions. Just to give a plug to our next webinar coming up that's on the screen, Advanced Planning Strategies for Successful Businesses, is Tuesday, April 27th. We look forward to that one.
Well, that's fantastic. Yeah, so tax planning is, again, there's many strategies that can be undertaken that can help you to structure your affairs, to mitigate the taxes that you're paying, create asset protection, introduce children and family members, shareholders directly or indirectly. There's certainly a lot of opportunities to arrange your affairs in a manner that does not compel you to pay more tax. Long live the Duke. And we appreciate all of you in attendance today. And we look forward to seeing you on, what's the date again, Mayor?
April 27th.
That's great. And subject again is?
Sorry, where was the subject?
Tax planning for successful Canadian businesses.
Correct.
One of our favorite subjects. We look forward to seeing you all then.
Thank you.
Thank you very much, Mayor, Michael, and everyone in attendance.
Bye, everyone.
Bye-bye.